So today I'd like to talk about taxes. I suspect that a main reason people get so anxious around tax time is that they delayed so many important things, like organizing their paperwork, contacting their accountant, and taking advantage of opportunities that could lessen their tax burden. While you are on your own for tackling the first two items, I can help you with the last point, taking advantage of opportunities that could lessen your tax burden. In fact, there are a number of things you can do that could potentially reduce next year's tax obligations. So let's take a look. First, let's look to losses. If you think your investments will produce capital gains, whether short or long term, you can offset those gains with capital losses. As you're aware, the market has been less than optimal this year, so there may be some good opportunities and good reasons to get those stubborn stocks out of your portfolio. If you do believe in the company and you want to continue to hold it for the long term, but you're currently underwater on the stock, please reach out, as there are some ways to capture the losses for the current year, but also maintain your exposure to that company. For assets that you've held for less than a year, any gains, which are considered short term, are taxed at the ordinary income tax rate, so from 10 to 37%. And you can offset those with short term losses. For the other assets that you've held for longer than a year, which are considered long term gains, those gains are taxed at a top rate of 20%, which can be reduced by, you guessed it, long term capital losses. Now, if your losses are greater than your gains, that's good news in the sense that you can deduct up to $3,000 in your capital losses against your ordinary income for that year and carry forward any unused losses to the future. Because of this, you might want to avoid short-term gains since these are taxed at the higher rate. To do so, if you believe you'll have a short-term gain for the year, try to either offset it with a short-term loss or consider holding the asset for at least a year when it will become long-term and taxed at the lower rate. Now, this requires that you review your portfolio regularly and estimate your gains and losses. Most capital gains and losses are triggered when you sell the asset, which offers you the control over the event. However, with others, like mutual funds, for instance, they're difficult to predict as they're made up of a number of assets and they dictate when they sell. If you find that your assets have performed poorly, consider using them to offset your gains as it will reduce your capital gains tax. Now, keep in mind that it's beneficial to elect a loss before a gain because you can carry over that unused loss to the future, whereas capital gains are always taxed in the year that they occur. But as the tax laws change often and they are complex, please consider speaking with a tax professional to help you manage your tax burden. Now, I know we covered a lot, but if you have any questions, please feel free to give me a call, and we'll see you next month with a new video. Have a good day. Thanks.